Okay, so now there are basically four basic options, like so strategies, whatever. One is call buy, right? Call sell, and put buy, and put sell. Right. So thankfully we can picturize it. Once I put in the graph, you will, by the moment you see any strategy as and its equivalent in the picture, you'll get a very clear picture. Okay, what is the risk and what is the reward and how that strategy is going to actually behave. So these four I'm going to picturize. Buying call is called basically long call. Okay. Suppose you bought an option and you paid certain price, $1,000, whatever. So that is the maximum risk. This particular area is the maximum risk that you can lose. All right, and this is the reward, and this is long call. Okay, so the moment you see, you should understand. Okay, so the risk is limited and the reward is unlimited as the price keeps moving up and up, up and up, up and up. So it's basically infinity. This is profit, and this is the break-even line, and this is the loss. Okay, on the y-axis we have profit and loss, and x-axis we have the asset price. So for example, Nifty is moving up, Bank Nifty is moving up. So as the asset price keeps on increasing at whatever strike, right? So because you have bought the call, your loss is limited to that particular number. So your loss will not be unlimited. So this is the limited loss, right? So as the stock price keeps on increasing, at some point your your profit keeps on increasing at some point. So here basically it overcomes the cost of for a buyer to make money, the option price has to cover the cost. For me to sell, for me to lose, for the seller to lose, I always keep saying me because I mostly sell the options. It's like, I have to lose the premium that I received. Even if the price is against me, I have to lose the premium and then further away. When they start making, then we start losing. So this is the maximum loss and this is the reward, huge reward. Clear? Right, so we call this a long call. Okay, this is basically nothing but buying a call option. And if you say the expertise, it can be a beginner. And everybody starts with this, buying a call or buying a put. This is basic understanding what we actually start with. Nobody goes to complex strategies right in the beginning. And it's totally fine but if you just understand buying and selling at initial phase, like for one month you can just do the buying and selling. So a lot of people unfortunately they start with buying and they end up their lives in buying which is a disaster, I would say. And they somehow keep on, instead of learning more and understanding the strategies, the complexity, and then turning them to their advantage, what they do is they buy the option and they buy FAR OTM options and they keep on hoping that. And I have seen in the media when they say the moment they are saying options, they always sell option selling has unlimited risk, option selling has unlimited risk. So somehow the retail investor has in his mind scripted that option selling is unlimited risk, so it's not even for you, so just stay away from it. So they start with buying and they remain the buyers lifetime until their bank accounts run out on. So this is option, buying an option. You can be a beginner, but I would say don't stay here. You need to get to the advanced strategies. So expertise is a beginner. And what is the market outlook for this one? Market outlook is bullish. Right? So you will only make money when the asset price goes up. So you're bullish. So you're expecting the price to go up. you'll buy the call option. All right, so this cannot be used for income or range bound or whatever it is. It has to be directional. It has to be directional. If the market goes against you, the market doesn't move the way you expected, I would say get out quickly. And if at all you're very confident, for example, if you have to buy, you feel like no, eventually, then I would say at least go for a long-term option, like 3 months kind of. That is 3 months. For example, you say like, okay, the markets have now come to 16,000 and like absolutely I have no doubt that markets will cross 16,500, for example. So in that case, you should give sufficient time to yourself that you are right. You may be wrong in a short run for 1 week or 2 weeks or something, but when you buy a longer option, the time decay will actually protect you. You have bought enough time. But if it is a weekly option, for example, and if things go, then if they don't come back up, then you lost it, all of it. So number one is theta. Okay, buy enough time. And when you buy longer time, when you buy more time, you'll be amazed to see that cost of 3 months divided by 3. Okay, so per month whatever you get, it is much less than 1 month. You understood the point, I guess. So if 1 month is costing you, for example, $100, but when you buy for 3 months and then you divide by 3, you may probably be paying $65 or $70 like that. So if you want to buy a call option or a put option, if you are very confident on your analysis or whatever, try to buy more time so that you are right. It works. And what else? That's it. So this is long call, and then we'll cover long put, and then short call and short put. So the next simplest strategy for people, for the beginners, is buying a put. Okay, called long put. Okay, this is asset price of underlying asset, whatever it is, SPX, Nifty, Bank Nifty, and here is the break-even point. And as the asset price, as the prices start falling, okay, at one point you'll start making money, and it will go and hit you. Okay, if you had observed with the call, it goes to infinity. It doesn't go and meet anywhere. But in case of put, all right, so this is called long put right here. This in case of put. All right, this is loss, this is break-even point, and this is profit. Okay, in case of put, say asset price somewhere it goes and it becomes 0. Fine, so it is not infinity, it is defined. Maximum price it can fall is 0 of a stock, not minus. So yeah. Limited risk. Whatever price you pay for buying an option, and then the price keeps falling, his profit goes on increasing, and is going to meet over here. We will say expertise, again basic, or we can say beginner. Market outlook, bearish. All right. So the buyer of the option thinks that the market is going to go down, so I'll make money with falling prices. So more it falls, more dramatically it falls, they'll make money. And people buy it for hedging as well. Like if they fear that the prices can fall and they need the protection, they can do it. It's also called, it's used for hedge. Perfect hedge. Okay. And my recommendation would be, yes, use it for hedging and use it in spreads. Don't buy naked puts. So the third one is short call, also called selling a call. It's nothing but selling a call. Okay. When you sell the call, you take unlimited risk. As the price keeps on rising and rising and rising, you'll make unlimited loss. And it would look something like this. All right, so this is asset price. This is asset price. And here it's actually moving. As it keeps on moving, this is the break-even point. This is loss, and this is profit. So the profit is limited. Say for example here. And as the prices keeps rising, there will be at one point of time break even, and then you will keep on losing as the price keeps on moving and you keep on losing. So the loss is infinity or unlimited. This is unlimited, and profit is limited to premium received. Right? You're selling a call, it's called short call, and it's basic, just sell the call, and your profit is limited. This is the break-even point, and your maximum loss, your maximum profit is equal to the premium that you have received. And your loss, as the stocks keeps moving higher and higher and higher, you are going for an unlimited loss as the price keeps increasing. And for this, extremely dangerous. So expertise is advanced if you're going for naked calls. And the market outlook, if you're selling a call, you want the market to fall. You don't want, say for example, if the price remains in this range, you're totally fine in this range. You'll only start losing when you start reaching, when the price starts increasing here. Over here, you're fine till here, and then you start losing money over here. So your expertise should be advanced when you're selling the calls. Your market outlook is bearish. So there are two ways you can make money with a falling market. One is that you sell the calls. Other one is that you buy the put. Okay. So we have seen how buying the put works. It's like this and it's like this. You will actually make money by falling prices. So, and what do we say? Don't sell naked. Selling the calls naked, now it needs a lot of margin. Number one, you require a lot of margin. You can actually collect much more premium by hedging the positions. You hedge you sell the call, then you buy the call. So you actually, your margin is left, like from 150,000, you're only spending 50,000. And then you can sell twice, thrice, 4 times to actually collect the same amount of premium. Say for example, okay, we will cover this in the next classes. Why you should not be selling naked and why you should be going for spreads. So this is the basic outlook of a short call. We covered basically 3, buying a call, selling a put. So I think buying a put, and then now we will cover selling a put, short put, long put and short put. So this is nothing but selling a put. And the way it looks like on the diagram is like this. This is the asset price, and say for example this is the break-even point, and this is the loss, and this is profit. All right. So whenever you sell whether a call or a put, the profit is limited. And you will actually start making more and more loss as the asset price keeps on falling. For example, you sold a put, you collected the premium. Here you stand. And as the asset price starts falling, you will come here, right? So again, it's not infinity. The loss is not infinite. The loss is maximum loss is as the asset price comes down, 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 it may go to zero. So again, selling shorts without any cover up is dangerous. Market outlook is you're bullish. You think the market is going to go up, so that's why you sell the put. Okay. We're not talking about adjustments and all. Like say, for example, if the market goes against you, the sellers are not fools. You know, the moment you look into the chart with limited profit and a hell lot of loss, it gives an immediate thought like, why the hell anybody is going to sell the options, right? So that's not the way it works. There are options that they can actually hedge. They sell the put, then sell the call and buy the put. There are a hell lot of options to actually hedge your positions. I would say market outlook has to be bullish, expertise has to be advanced, all right? Because you're taking unlimited, hell lot of risk, so your expertise has to be advanced. And what else? Okay, market has to be bullish. It's dangerous because if you are selling it naked. That's it.